Monetizing the American balance sheet, how your home became government revenue. 1. The announcement nobody heard. 12 months. That's the window. The Treasury Secretary said it quietly: the United States will monetize the asset side of its balance sheet. Translation? The government plans to turn what you own into what it owes. So what does that actually mean? It means your home equity, retirement safety, and net worth are already being mapped as potential revenue streams. The U.S. debt is near $37 trillion, heading toward $50 trillion within a decade. When the math stops working, the state doesn't cut spending, it looks for fresh collateral. This time, the collateral is you. Footnote: governments never default, they repurpose what citizens already own. 2. The quiet target. America's homeowners are sitting on roughly $35 trillion in equity, the largest untapped pool of wealth on earth. About $11.5 trillion of that is tappable, meaning accessible through new loans or liens. 2/3 of it belongs to those with excellent credit. Guess who gets squeezed first? Not the reckless, but the responsible. Policymakers call it leveraging national assets. Economists call it financial engineering. You call it what it is: monetizing your house without your consent. Footnote: when the state calls something an asset, it often means future tax base. 3. Step 1. The inflation tax you never voted for. Property values rise. You smile. Until your county assessor smiles too. The bill catches up, 50%, 100% increases, and you didn't get a raise, just a reassessment. Property tax collections are exploding, not because you got new services, but because your paper gains got harvested. Nevada is already testing a constitutional change to reprice at sale. That's a stealth wealth transfer, one closing at a time. Footnote: inflation makes homeowners feel rich just long enough to tax the illusion. 4. Step 2. The Trojan horse fix. Here's where the language gets cute. They won't say new tax. They'll say reset fee, service modernization, or fair share adjustment. After all, who could oppose fairness? These levies will be tied to property value, not income. Meaning even if you earn less, you'll pay more, because your roof appreciated on paper. It's the oldest trick in Washington: rename the burden and sell it as reform. Footnote: every modernization fee is a tax wearing makeup. 5. Step 3. The friendly trap. They'll dress it up as help. Enter the new equity release programs. Think reverse mortgages with patriotic branding. The FHFA just approved a pilot program allowing second liens up to $78,277 directly against home equity, government sanctioned, Freddie Mac backed, and sold as assistance. In practice? It's the backdoor nationalization of home wealth. So what does that actually mean? It means your deed becomes a revenue instrument. Footnote: every pilot program is a proof of concept for policy. 6. Step 4. Spending the illusion. The Fed's data shows that when home prices rise, consumers spend more, even if it's only on paper. That's why policymakers call home equity a stimulus lever. In the 2000s, homeowners withdrew nearly $900 billion per year in equity. Today, that number has fallen by half. To Washington, that's a problem: too much wealth sitting still. The solution? Loosen the taps, encourage responsible extraction, and watch the flow right back into taxable consumption. Footnote: the fastest way to raise GDP is to make citizens borrow against themselves. 7. Step 5. Beta testing the confiscation. No government rolls out a policy nationally without first using test markets. Watch Texas, Florida, and Louisiana. These states will see new affordability pilots, community equity unlocks, and emergency homeowner funds. That's code for trial runs. The playbook is simple: when values fall, the state calls it stabilization. When they rise, it calls it redistribution. Either way, the household loses first. Footnote: before national rollout comes regional rehearsal. 8. The modern justifications. How will they sell it? Easy. Trade a small piece of your home to erase student debt. Use equity to fund infrastructure and climate upgrades. Do your part for resilience. The rhetoric writes itself. You'll be called patriotic for liquidating your nest egg. So what does that actually mean? It means they've rebranded seizure as solidarity. Footnote: every national emergency doubles as a fiscal opportunity. 9. The historical echo. We've seen this before. 2008 was marketed as a rescue for banks. Homeowners lost trillions, institutions gained liquidity. The pattern didn't die. It evolved. Each cycle, the instruments change, but the hierarchy doesn't. When the state faces insolvency, the citizen becomes collateral. It's not conspiracy, it's accounting. Footnote: history's most efficient bailouts are called stabilization measures. 10. The three futures. Scenario 1, the boom trap. Markets surge, assessments catch up, and fixed bills double. Scenario 2, the inflation grind. Prices rise slowly, but your money buys less. Scenario 3, the equity harvest. New liens, new aid, and shrinking cushions. Each route ends the same: you pay for their math. Footnote: in economics, shared sacrifice always means someone else's gain. 11. Countermeasures. Fight the bill. Appeal your property assessment with real evidence, lower sales, repair quotes, photos. Many appeals succeed. File your homestead and all exemptions: veteran, senior, disability, portability. Use long-term fixed loans paid by rent income, not your paycheck. Line up small business credit or seller financing before you need it. Buy only what cash flows on day one. These are not loopholes, they're armor. Footnote: defensive finance isn't paranoia, it's policy literacy. 12. The real choice. The Treasury has shown its hand: monetize assets, focus on housing, extract value. The clock is ticking. Either your equity becomes their solution, or you learn to make the system pay you instead. So what does that actually mean? It means adapt before you're drafted into their balance sheet. Footnote: those who understand the policy become the policy's exception.